So much for tuning into Talking Point. I'm your host Neeraj Shah, and the Talking Point today are the views of Vikas Khemani, who's probably seen multiple such cycles, and would be lovely to understand from him if this time around he sees something which is different than what the previous few have meant for Indian markets and global markets, arguably as well. Vikas, great having you. Thanks for joining in at a crucial time, though. Much appreciate you taking the time out. What's your sense, Vikas, about whether this is one more of the corrections that have happened in the past? At some point of time, it'll get bought into, yes. But is it possible to pencil in or put a finger on the pulse as to when can it happen? Or is it too fluid a situation right now?
Hi, Neeraj. I think, very frankly speaking, right now, the way I see is that things are slightly open-ended from a point of view of the inflationary environment has far exceeded I think probably most pessimist market player. I think especially in US, I'm talking about. And it is led by, of course, Ukraine war, China, and many other issues, tariff hikes and stuff like that. So I think and this it looks like that it is unlikely to settle in a hurry, and Fed is probably, I mean, we all know that they're behind, but you might see some sort of knee-jerk reaction. That is what right now markets are expecting. Now, we know that how macros are, they change in no time. 4 months ago, 5 months ago, I don't think anybody expected Ukraine war and things to kind of get compounded so badly. So things are where they are. So I think, in my opinion, given the way where macro plays out, especially from a US economic perspective, things are looking fluid. But I do believe that India is not as worryful situation as US is. US is sitting on all-time high balance sheet. US is sitting on an all-time high inflation. US is sitting on some of the structural problems of the growth. While India is actually in the middle of a structural growth pool, our inflations are not as bad as in US. US normal inflation is 0% and back at 8%. In India, our normal inflation is 4 to 5%, and we are at 7%. And once the energy price settles down, which I do believe, whether it is a matter of 3 months, 6 months, or whatever, once the Ukraine crisis settles down, energy price would settle down. There's no sort of doubt in my mind. Now, the meanwhile, what kind of damage gets done is the question to be sort of looked after. So I think relative basis, India is better placed. We are unlikely dependent on foreign capital as much as we have been in the past. In the last cycle, when the Fed was raising interest rates, we became part of fragile five because our current account deficit went to 4% of the GDP, as well as our portfolio flows were going down. This time around, if you see, despite such a massive exodus of the portfolio flows, we are still holding pretty well. Our inflation, current account deficit is holding well, despite such a high energy prices. So I think we are on relative basis much better place than we've been in the past. But when markets kind of go through this kind of phase, global meltdown, we cannot remain unimpacted. And that is where I feel that from India's standpoint of view, next 3 to 6 months, uh, amid this uncertainty, would be the best time to buy.
Hmm. Um, are you already sensing opportunities there, or for now? Because I mean, the reason. Okay, let me rephrase my question. If the US sneezes, the world catches cold. It happens all the time. So even if India might be better placed, because if the US markets continue that tailspin, would you reckon the collateral damage has the potential to take the markets even lower than where they are right now? Even if the other macros of India might be relatively better, though crude at 120 is probably the biggest bugbear.
It is possible. It can't be ruled out. As you rightly said, that it depends on the extent of panic and depends on what kind of development takes place. In markets, never say never, and it is possible that it can trade lower than these levels. Though I think markets have found multiple support around these levels of 15,700, 800 levels. But in markets, with short term, anything is possible, and I think it's quite possible that markets might give in another 5-7% if US were to kind of get into a meltdown kind of situation. Uh, like I said, the silver lining is that things will come back. We look, our problems are not structural, our problems are good. So in that sense, that's the reason I said next 3 months, because I don't think this is going to get over in a hurry. It is going to pan out over the next 3-6 months in different ways. And as that happens, I think you will see volatility to continue in the markets. If tomorrow good news comes, let's say Ukraine war stops and energy prices start correcting to $70-$80, I think we are back in the game. And one thing I have seen, when events develop, they develop overnight without anybody expecting. Both sides, either positive and either negative. Right now, I think there is a huge amount of pessimism. There's a panic. Definitely, there's no doubt on that. And that panic is creating havoc in the market. Good part is that there's not much leverage position in the market this time around. Generally, leverage positions do cause very sharp cutbacks. And I don't see very high leverage position when markets are subjected to high leverage position with a very sharp knee-jerk reaction. You see deep cuts, and like what happened in case of pandemic. I don't see this time around markets are slowly prepared. There are short positions in the market, and to that extent, I think we are unlikely to see a very sharp, deep cut, like let's say 15% in a day kind of things. In my opinion, like it
Mm.
happened in GFC or in pandemic time. I think that those kind of things, in my opinion, would be a less probability. But like I said, markets, you never say nothing can happen. Markets, everything is possible in a shorter term. That's the construct right now. I am seeing that marked by worry, a lot of sort of uncertainty, and that's likely to continue for a few more months, I guess.
Mm. Because in your previous role, most certainly, and maybe in your current role as a money manager too, you must be talking to some of the big global funds, who FIs who put money. Now, it's been a non-stop one-way move, and I know it's a fraction of what they actually hold. But this is the question on everybody's mind: that for how long can the FI selling continue? Lay out for us how you think about it when you see these numbers.
So typically, I think whenever the Fed raises interest rates, very simple reaction of most of the funds in developed market is to pull out from the emerging markets. It happened in 2013-14 period. It is happening. It happened before around GFC. It is happening now, right? So, and typically we have seen maximum selling around 4-5% of their holding, of overall holding, which we already seen happening, right? I think FIs have already sold about 5% of their total holding. But I mean that there's no sacrosanct number around that. But my point is that it should ebb, recede, or stop once the clarity comes that interest rates are kind of close to peak out, or from here most of the interest rates things have got factored in, and that's the time you will start seeing flows to come about. So in my opinion, some amount of rise has already been factored in. You might see some more coming through, in couple of months. So I don't see FY calendar 23 a major sell-off here. I think whatever has to happen, in my opinion, should get done in next couple of months, and maybe in through this year. Beyond that, I don't see much selling continuing.
Got it. Because different people deploy different strategies. There are some people who are talking about sitting on cash, not because they believe that the markets are necessarily very undervalued or very overvalued, but because they want to take advantage of the sharp swings and the volatility that may come about in specific bottom-up opportunities as well. Are you sitting on a lot of cash, or is it normal levels for you and your portfolios thus far?
We are not sitting on a lot of cash. But two strategies. One strategy we are sitting in reasonably good amount of cash. One strategy we are not sitting as much as cash. Partly also because we were just deployed and we did not get a chance to kind of book some sort of gains. But I think broadly speaking, we don't play much on the cash creation as a strategy. So we are pretty much at the normal level. In one strategy, coincidentally, by just the sort of a coincidence, we were slightly larger amount of cash. But I think we will probably at the right point in time, and we keep reviewing, shuffle some of the portfolio, because as the markets go through every correction phase, you find some interesting switch ideas, and we will definitely be mindful of that, and we'll be doing that.
Got it. Because one final piece, because I understand we have to let you go as well. In the last 12 months, I've heard you sound constructive on the business prospects, and thereby, of course, stock price would follow earnings, but on the business prospects of BFSI and banking in particular, to an extent IT, where you've been bullish for a while. I don't remember the last stance, but at least some time ago, you used to be bullish, and on manufacturing as a theme. Now, my question is, because of all the developments that are happening around the world, have your preferences changed? Have you thought of switching out of some of your favorites into something else that may look more attractive?
I think all things remain same, Neeraj. I think there's no doubt on that. In IT, of course, we have given away some of the gains which we had, because and we booked partly profit, but we still are overweight. We were 25% overweight, but we've come down to like I think around 18-19%, but still we are overweight, which is kind of hurting us. But that's the nice part of the game. But the business side, I think, is holding on very well. Banking, I think we continue to remain very bullish because interest rates are rising. In India is one of the under-leveraged countries. Credit cycle has just begun. So I think banking will do well. IT again post these corrections, I don't see much reason to worry. Correction valuations have corrected. Demand environment continues to remain robust. Also, demand is and IT spend for US companies will be deflationary. So to that extent, I think it will continue. Manufacturing is a decadal opportunity. I don't see any change in that happening. I think capital goods is something one should watch out for because I think in the inflationary cycle, as the demand picks up, you will start seeing investment cycle picking up. Already we are beginning to see some sort of signs of that. That I think will probably a bit of a leader in the next rally as the market recovers from this correction. So we might make some tweak around that, but otherwise broadly, I don't think our thesis has changed much and will continue to remain because we think this thesis here to stay from 3 years, 5 year kind of time frame and maybe even longer. And I think we broadly will stick to our portfolio construction.
Great. Vikas, lovely talking to you. Thank you so much for being with us today and giving us your thoughts. Much appreciated.
Thank you, Neeraj. Always great talking to you.
Yeah, always great having you, Vikas, and viewers, thanks for tuning in.